Good morning, everyone. Welcome to another iteration of Value Investors Edge Live. We're recording on the morning of June 11th, 2021 at about 10 o'clock Eastern Time. Today we're hosting Dorian LPG, CFO Ted Young, who's going to talk to us about the global LPG shipping markets, as well as their specific niche in the VLGC, very large gas carrier markets. We're also going to talk, of course, about Dorian's prospects, their capital allocation priorities, and what they see ahead in the market. As a reminder, nothing on the call today constitutes official company guidance or investment recommendations or trading guidance on my behalf. I have a long position in Dorian LPG. This is being recorded on the morning of June 11th, 2021. So if you're listening to a recording at a later date, make sure you look for those latest disclosures. Ted, good morning. Thanks for joining us today.
Hey, good morning, Jay.
Yeah, it's good to have you back on our podcast here. We've done a lot of interviews over the last couple of years, right? We've stayed in touch as the markets have really improved starting in 2019, early 2019, and we had a solid run. COVID gave us a little bit of a disruption, and we're right back to a solid market again. Rates are fading a little bit recently, but they're still strong, but they've been fading a little bit as the arbitrage is closed a little bit. Can you talk a little bit more about the current market and some of both the benefits or upsides, as well as maybe some of the risks or concerns in this current market?
Absolutely, Jay. And thanks again for giving me the opportunity to speak on Value Investors Edge again. So yeah, you're right. Rates have come off a little bit. We're probably sub 30,000 a day on a traditional, on a non-dual fuel vessel. I think what we've noticed is there's right now there seems to be a bit of directionlessness in the market. We've now started to see U.S. inventory levels increase. That usually is a pretty good leading indicator of exports and more competitive export pricing. And hopefully we'll see some pressure on U.S. prices of LPG that will increase demand in Asia. And also the ARB is open right now versus naphtha, and that's an important part of the business. So, I think our general view is we view this as short-term. I wouldn't even call it weakness. It's just short-term directionlessness, which has created some, obviously some weakness. As I look out ahead, Jay, I continue to be reasonably constructive on the outlook. I say reasonably because I'm not an optimist by nature, and nor am I supposed to be as CFO. But if I look at sort of the facts, the macro backdrop is, continued return of consumer demand and industrial demand, and 28% of global LPG goes into petchems, more specifically the plastic sector. 55-ish% goes into heating and cooking, and so we definitely got some benefit from folks being locked down. I think we'll just revert to sort of the regular way growth, which is we'll continue to take market share as a product from other heating sources, etc. Add on top of all the good secular drivers, vessels are required to dry dock every 5 years, and it happened that 2016 was a big new building year. So we're expecting a significant number, and I've already seen a significant number of VLGC dry dockings. Depending on which broker you talk to, it's 75 up to 90 vessels will be dry docked during this calendar year. So that creates obviously some real slack in the market. And then, one other thing which I know you're focused on, but I don't know that it's gotten as much focus in the broader investment community, is the change that the Panama Canal Authority brought on at December 31 or January 1 in regards to the ability of VLGCs to pre-book slots. In the past, VLGCs had a pretty good window to pre-book slots. The change is that they've really, I won't say eliminated, made it much more difficult for VLGCs to pre-book slots at the Panama Canal. As you know, that's an important transit point for product going from Houston, the U.S. Gulf, to Asia. And so those delays, while operationally irritating, have also created some additional length in the market. So, overall, there's a number of secular as well as some sort of unique to shipping logistical factors that set up pretty well for the next little while. And certainly there's a new build order book, but it's not unmanageable. It's about 60 vessels, and that compares to a not dissimilar number of vessels over 20 years of age. And as we all know, there's a lot of technological change on the horizon for shipping, specifically means of propulsion. So while historically the scrapping age has been about 28 years, we expect that these additional regulatory changes are going to put pressure on that. So when I add all that up, it sets up for a pretty constructive view of the near term and the medium term for VLGC rates.
Yeah, thanks, Ted. It's a good overview of the current market and some of the dynamics you're seeing. One of the things that's came across our radar, especially the last 3 to 6 months, has been kind of the surge in order book for VLGCs, particularly the dual fuel vessels. That's ramped up a lot, considerably. It took what I thought was a very bullish, almost unquestionably bullish order book in late 20 into a suspicious, cautious, concerning order book. What are your thoughts on that? Does it pose a pretty big risk to the sector, or do we need to be concerned about 2023 and beyond?
Look, I mean, so my comments relating to the outlook were sort of more focused on 2020, the rest of 21 into 22. 23 is a long way away from my perspective. I won't dispute that. Look, no ship owner likes an order book, but there's another piece of the regulatory puzzle which is worth mentioning. So effective Jan 1, 2023, these new EEXI regulations will come into effect. Now they're still finalizing what that's going to be, but the general consensus among industry folks is that it's going to lead to EPL, or energy power limitation. That means we're going to have that older vessels will be required to slow down to limit their carbon emissions. So while you're right, Jay, we do have I think 35 vessels coming online in 2023, which normally would give me a bit of pause, and it does give me a bit of pause. I'm not going to say it's no risk, but on the other hand, again, when I think about the fact that we could see some accelerated scrapping going into that, because those older vessels, 20 years and older, are going to be much less competitive. And then when I take account of the fact that we're going to have an overall fleet slowdown in anything that's not, I think it's tied to like the most recent class of new build. Now I don't know if that's 2020, 2021, what year it is, but suffice it to say that the majority of the fleet, even modern tonnage operators like ourselves, may have to are going to have to slow down a little bit to comply with these new carbon emissions regulations. So that does give me some comfort on the downside that, what normally would have been kind of an obnoxiously large number will hopefully not have that significant an impact as it might have historically, again, really supported by a lot of these regulatory changes.
It's certainly interesting to watch what's going to happen there, because as you mentioned, even the EEXI stuff is still getting finalized, and that's just the start, right? I mean, that's just step one. There's step 2, 3, 4, 5, 10, right? Yes. After that.
Yeah, absolutely. I mean, the carbon-free future is, upon us, and again, I don't know that we'll see a carbon. I know that I'll see a carbon-free ship in my lifetime. Because frankly, unless there's a lot of carbon emissions that go into actually producing the ship, right? And then propulsion is, there's a lot of work going on to it, and getting net zero propulsion sources is also a challenge. But all those factors are, it's an unavoidable fact of life, and it's going to affect shipping. And I do think LPG in that regard is reasonably well positioned as a sector, because it's a good bridge fuel, and we are using it as maritime fuel in the industry, and we'll use more of it, I suspect, going forward. But you're absolutely right. It's a lot of change coming, and certainly interesting to watch. And nobody likes an order book.
Yeah, nobody likes an order book. Amen to that. So thanks for not contributing to that order book yourself. We do much appreciate that as investors. We appreciate the return of capital in terms of the tender offer that you did, the repurchases you're doing. Definitely favor that aspect. So dual fuel, right? I mean, that's almost all the new builds. Not all of them, but most of them are dual fuel. You have a peer, BW LPG. I'm also long them. I'm playing all sides of the field today, Ted. They've signed up to retrofit 15 of their ships. Do you plan to follow along and do some of these retrofits? Are you still kind of studying it? What's kind of your thought process there?
Yeah, I think we've been pretty consistent in our public comments on that, Jay. I think there's no question about it. It's interesting. I think where we're still trying to make the math work is kind of on the payback. Look, you're looking at really an $11 million investment. You're looking at probably 60 days out of service. So depending on the market rate, the market environment, that's a big chunk of change. And then you're betting on the fuel differentials going forward. So on our math right now, that's sort of a 5 to 7-ish year undiscounted payback, and that's okay. It's not, but I don't think anybody on this call would get overly excited about that. So I think from our perspective, we are trying to find. We're hoping that those costs come down, or that we can get better visibility on some of these technological changes, because look, if the other ships have to slow down, then that makes the investment in the LPG that much more attractive, because your ship will be that much more commercially advantaged, and you can start tweaking some of those assumptions and getting things down to a level that's going to make sense. And so but again, I think and I do have to point out, we did contribute a little bit indirectly to the new build order book. We did agree to take on a new building out of Kawasaki in March 2023 that's being built by a Japanese partner. It's a bareboat charter, so we will technically operate and manage the ship. But it's essentially a debt financing of the vessel. So we're not entirely non-culpable in the growth of the order book, but others are far more responsible, like the Vons. They've got 6 in the book, I believe. But at any rate, the retrofits, we think are interesting, and we've been really focused on the economics. And I think we'd like to see a little bit improvement in price and a little more certainty around the fuel price spread between LPG and VLSFO before we start cutting checks.
Certainly makes sense, Ted, and thanks for your integrity of not letting the free pass slide. You added one on there with pretty attractive financing, but still you did contribute one bareboat. So thanks for flagging that, Ted. I appreciate it. So look, what's the current cost of these retrofits? Because I know last year when they were getting thrown around, it was 8 to 9 million, and not only was it 8 to 9 million, there was this huge opportunity cost, right? Because you had to stick your ship into a extended dry dock, and you missed out on what was a huge market. So opportunity cost aside, because that's a moving target, what's the current cost for one of these retrofits, and how long does it take? How far in advance would you have to book one of those?
So the current cost is between $10 and $11 million. It's about 60 days in dry dock. That may or may not include sea trials, which would only add 3 to 5 days. So but in the yard, the yards are getting better at it. In terms of booking a slot, because you should. There's more yards that are available to do it than just the yards that build the ships. And you don't. It's a ton of work. You do need to be in dry dock for part of it. I still think you could probably, from what I understand, you'd have no problem getting a slot in 22 at this point, which, just goes to show there is enough, retrofit capacity out there.
Okay, that's good to know, because obviously the new build side of the market is completely jammed, right? We got containers rolling in there.
You're into mid to late 2023 for a new build. That's right.
Yeah, that's significant. So we're already in the tail end of 2023. How has the rising steel prices and the current surge in container ship orders, how has that impacted the pricing for a new build VLGC? Has there been much of a move yet?
we haven't seen much of a move yet. I think, look, the container ship issue is slightly more of an issue than the steel price. So, historically, the biggest driver of new building prices has been what's going on in other sectors, because look, there are more yards that build container ships than build VLGCs. There are really, 5 yards that build VLGCs, and 2 in Korea are responsible for the vast majority, and 1 Chinese yard catching up. We are building at Kawasaki in Japan, but just because the cost structure of the Japanese yards are not nearly as competitive. The steel price hasn't been much of an issue because most of the steel that goes into our ships is really such specialty grade. It's expensive regardless, and doesn't move around that much in price. It has a higher nickel content, so it's usually pretty expensive, but it doesn't drive much overall. It's really, where they're making more money, and you tend to get a better price when you place multiple ship orders, because there's a learning curve and a per unit cost reduction for the yards. So, they make more money on ship number 10 than they do not the ship number 1, and they price accordingly.
Yeah, that definitely makes sense. So a one-off would be a lot more expensive. You definitely have to partner up with somebody or do a larger order if you want to get better economics. You mentioned, I want to circle back because I probably should have done it earlier, but you mentioned 10 to 11 million for a retrofit cost. Is that just all in for the equipment and dry dock? Does that include any sort of opportunity cost, or is that literally just
no,
the
that's no opportunity cost. I mean, if you look at the numbers that I think when BW came out, and I won't pick on them, even though they went hostile on us several years ago. I think they gave a pretty wide range because even they weren't sure, and I think their more recent disclosures have been called it 9 to 11, and we haven't seen the 9. We're hearing 10 plus, and that's because look, you're in the yard for 2 months. That's just expensive in and of itself. The equipment. And I don't remember the breakdown, quite honestly, Jay, between yard bill and equipment and everything else, but that's quite a lot of, as the Brits would say, that's a lot of kit to put in. So, I think 8 was pretty optimistic. And I was on a panel last week with Anders Onerheim, and he said, yeah, it's still about 10, but we're, it's coming down a bit, so, 9.8 is better than 10, but it still ain't 8, and it's still 60 days, in dock.
Yeah, thanks, Ted. I think there's always a breakdown with equipment costs, because they say, well, the actual retrofit, the engine adaptation is 8 million, right? But then you have $1 million of other parts that go into it. You have $1 million for the dry dock. You have 3 or 4 million of opportunity cost, and suddenly you start with 8 and you end at 14.
Yeah, exactly. I mean, the opportunity cost is real, as you said. It's a moving target, and given the lead time on the equipment. And given the lead, the modest lead time on slots, you can't move it around. I mean, with a regular dry docking, you can move around a little bit. We had some dry dockings that we were supposed to get done last year, and you can get a bit of an extension from the classification society. And we moved stuff around because the market was too good. We were like, look, we're not giving up $50,000 a day because the technical guy says this is when we have to do the dry docking. We're here to make money, and the technical guy doesn't like it, but just say go figure it out, and they figure it out.
Yeah, certainly. I mean, well, in a 50, 60, I mean, it was even 70,000 for a little bit. Yes. So, I mean, it was a remarkable market, and things are tamping down a little bit now. We mentioned at the start, we talked about some of the dynamics of the arbitrage, and one of the dynamics of that is US inventory levels of propane, right? They're very low, and production levels of propane haven't recovered quite yet. Do you have any thoughts on that? Do you think that ARB's going to open back up soon? Do you think US production is going to improve, or is that sort of a struggle at this point?
No, I think we're continuing to see reasonable returns of production levels. Look, the ice storm in Texas didn't help anybody in the energy patch, LPG included. Look, when oil and gas production goes down, LPG production goes down. There's no no secret there. But we're starting to see some increase. I mean, propane inventories climbed by another 5.5 million barrels last week. I think year-on-year production is up. I don't want to misstate it, but the number 10% is what I recall reading and hearing just recently. But I'll have to check that, or investors should check that for themselves. But we are starting to see that, but again, it's going to take a little while to really get the full benefit of that, Jay, because once the inventories start growing, it takes a little while for the price effect to come, i.e., lower prices to drive the exports. So part of the reason we had such an increase in inventories was lack of exports because of a relatively closed ARB. So we're starting to see a little bit of light, some thawing, if you will, in the ARB. And as I said, it's still competitive because of the massive ramp in the oil price. It's still really competitive versus naphtha. And so what we're seeing right now is the Houston Flushing, not in Queens, in the Netherlands, rate is actually at a premium to both the Arabian Gulf to Asia and the Houston to Asia rates. So again, we do have these multiple trade lanes and multiple economic drivers that do, sometimes we do a little bit better than what meets the eye.
Yeah, we'll have to keep watching that. The most important, in my opinion, a bias maybe as a U.S. centric person, but the most important thing I'm watching are those U.S. production levels of propane, NGLs, and looking at those export volumes.
Yeah,
and
absolutely.
We got to see those come back up if we want. Yeah, I mean the market's good right now. Let's not let's not get confused. But if we want to see a return to great markets, we got to see those come back up.
Yes, we do. There's no question.
So speaking of recovery and reopening and the fuel prices going back up and things like that, let's talk a little bit about your scrubber economics. You did a partial scrubber investment program on your fleet. What sort of cost savings are you seeing now on a sort of day-to-day basis?
Right now, on a day-to-day basis, we're seeing $1,500 a day benefit on the scrubber ships. So, that's pretty powerful economics when rates are sub 30, and that's pretty good. And so that's actually probably it sort of suggests about $150 a metric ton differential between HSFO and VLSFO. VLSFO, as you know, Jay, being the very low sulfur fuel, and the HSFO being the less clean stuff that you can burn when you've got a scrubber. So, and I think when we did our modeling, we modeled out a sort of 3-ish year payback at about $100 a metric ton. So, we're ahead of the game, at least in terms of our base case. So that's good.
Yeah, thanks for the color. Are you hedging any of that, or are you just letting the market to kind of dictate your savings?
Yeah, we haven't hedged. We're just kind of sort of. It's a little hard to do because there is so much movement in the trade, and we do call a lot of different ports, and you end up having to paper's an entirely different game, and trying to do it physically is interesting but complicated, and so we've just been sort of taking as it comes.
Sure, just let the market come to you, and it looks like the spreads have been improving a lot year to date. And we would hope with jet fuel picking back up, we would expect to see the cost for VLSFO improve, and that way your savings will be higher.
Yep, exactly so
right. Fingers crossed on that.
Yep.
I want to pivot a little bit and talk about your 3 older ships, kind of. I don't want to say maybe non-core, but leaning in that direction. What are the plans for those ships? Are they potential divestment candidates, or do you think they're there for the long haul?
No, I mean, look. First of all, there's, to be very blunt, there's nothing strategic in about vessels. They're assets that increase and decrease in value, and they're assets on which you got to get a return. We're at this interesting inflection point where vessel values for these older vessels are actually quite firm. So, we could lock in, a good return by selling those vessels. And so, absolutely at, like anything at the right price, everything's for sale. And I don't think, we're talking about crazy prices. We've seen some activity in the age range of the vessels we're selling. BW sold the Empress for 2005 built for 40 and change. There was another 07 built that was sold for like 45, 44, something like that. So, we're seeing, we would definitely, are definitely open to and receive inquiries, without getting too much into it. You get inquiries, you get inbounds, and, we're certainly, there's nothing core about those. There's nothing core about any vessel. If someone wants to come and make us an offer for any of our ships or the whole fleet at the right price, we're there to listen. But on those older vessels, the pricing's firm, and we'd happily take some money off the table at the right price, and either return that capital to shareholders, fund retrofits, Lord knows what. But it's definitely an opportunity, and definitely it's the right time in the cycle to be looking really hard at that.
Certainly. Well, if you get a 140, 150 million in block proposal that comes across your desk, and you want to just buy out those last 2 leases and put 100 million tender offer back out there, I think everybody would be very happy with such a deal. So obviously you guys see what kind of offer you get, but I'm very I would be very excited if you sold those 3 ships.
Got it. Yep. Understood.
Well, let's talk about your target leverage and the required cash balances, because your leverage is quite low. It seems quite low. Can you talk about the target leverage and cash balance and how you feel about it?
Yeah, I think from a target leverage perspective, we feel pretty good right now. It's always a healthy debate among a management team about driving your cash cost per day lower. But I think by most metrics, we're extremely well capitalized in that regard. I think depending on what you want to look at, we're 40% debt to total cap. Probably a little similar, maybe a bit better, depending on whose values you use from a loan to value perspective. So I think we feel good about our leverage. As you alluded to, Jay, we have two leases that are slightly more expensive. So if we could figure out a way to take those out, we do it. Is it absolutely the best use of cash at this point? Not clear. I wouldn't take it off the table, but not. I wouldn't say it's something we're spending a whole lot of time thinking about. We've driven down our cash cost per day through a combination of deleveraging and redoing some of our financings, and some continued tightening up on G&A in particular. So now our cash cost per day is probably around $21,000 a day, down from like $23,000 a day. So that does suggest we can maintain some lower cash balances. In the past, as we've talked, Jay, I've said, gee, I'd like to have a fortress, 80 to 100 million of cash. That's probably, given the current realities and the near-term outlook, that's probably a bit more than we need. And when you and I had that discussion, I think that was before we had our revolver, which at this point is fully undrawn, and before we had paid off one of our vessels. And so, as we sit here today, we've got an unencumbered vessel, so we've really got plenty of firepower in the tank. So, I think, I won't be drawn on in this call about precise numbers, but I do think that there's a general feeling that with all the financial flexibility we've created, we can certainly comfortably operate with balances lower than some of the numbers you and I have talked about in the past.
That's great to hear, Ted, because as the balance sheet gets safer and safer and the leverage gets lower and lower, it does give you more flexibility, right, with that cash balance. And not only that, but the market, as you mentioned, has gotten better. And yeah, you're in the danger zone. I'm going to try to draw you out on numbers, but appreciate you giving us a range and some overall thought processes there. Look, you did a huge tender offer at $13.50. And not only did you do the tender offer, but you came across the top, right? You exercised that 2% additional option. You pulled shares down at $13.50. Your net asset value, I know NAV is debatable. Different analysts have different numbers. Some of them, for some reason, I can't figure out why, but some of them don't include like your pool receivables and your working capital, and who knows. But regardless, it's somewhere between like 21 and 23, 24 bucks. Your shares are at 15. You just pulled down a huge chunk at $13.50. First of all, amazing deal. That was one of the best capital moves I've seen in the last couple of years in the shipping sector. Can you continue to do some of that? Is there more appetite for more repurchases? Maybe another tender?
Yeah, I think I think we were. I would say the feedback from investors was virtually uniformly very positive on the approach. So I think it's something that our board was pretty pleased with the outcome of. And so, yeah, it's absolutely something we can do. We still have, authorization under the original repurchase. That didn't, the tender offer didn't go against the open market repurchase authority. So we still have authority there. And we continue to, evaluate, opportunities day to day. So, I think depending on sort of how the near-term market dynamics are, we would by no means exclude the possibility of another self-tender.
Certainly. I mean, at this price point, we're in the mid 14s as we're talking now, and it's a huge discount to NAV, and you have a beautiful balance sheet. One of the pushbacks I get, it usually comes from the bankers because I think they have some incentives in the pot. But one of the pushbacks I get sometimes is on share liquidity. We don't want to hurt our share liquidity. We want to have a good enough free float, all that kind of stuff. Where does share liquidity, but it is at some point, it's valid, right? It's a valid point at some point. So where does that come into the picture for you? You got 40 million shares out totally now. How low can we go? Can we go down to 25 or 30, or what do you think?
I think, I think 25 to 30 is probably, you run the risk of illiquidity. I mean, look, I think you guys know better than I do, but, a $600-ish million market cap company is a micro cap in today's capital markets. So, I do, I worry a little bit about falling below even 500, and candidly, I'd love to get to $1 billion. I'd love to get to $1 billion on the same asset base and the same share count, not by just getting larger, by building ships or some such thing. But I don't think we're there. I don't think it's a major consideration at this point, Jay. How's that? Somewhere in that continuum, it's there. We haven't, there's so many dynamics, right? Because depending on who sells, there's less overhang, right? Because look, one of the things that's hurt our liquidity over time was we had a number of large shareholders. Now that's changed over time. So, Secor is no longer a shareholder. Scorpio is no longer a shareholder. H&A is no longer a shareholder. BW, to the best of my knowledge, is not a shareholder, or at least a very small shareholder. Even in the last tender offer, Kensico, our largest shareholder, tendered. They've been in the stock for a long time, have been great partners to this company, and we're sad to see them sell down, but we get it. It's what they do. They need to redeploy that capital. And so some of that has improved the technicals. So that does probably help the overall analysis. But on the other hand, people do need to see, and if you're going to get people into the stock, they need to see enough liquidity to see their way out of the stock. And so, I do think keeping an eye on that average daily trading volume is pretty critical.
Certainly something to watch. And, one of the reasons we've been watching the daily volume very closely the last couple of weeks, because, we did a little sleuthing and we looked at, the annual report that came out, and we saw that, the share count had mysteriously decreased over the last 8 days. Are there restrictions on your current share repurchase? Is it 15% of volume? Is that correct?
It's the safe harbor under SEC rules is 20 to 25% of weekly, the trailing 4 weeks average daily trading volume. So if you go to AQR and Bloomberg under our stock, I think it's AQR or AQS, I always forget. But in any event, it'll tell you what the 10b-18 limit is. I mean, I think as we sit here now, it's around 90,000 shares a day.
Okay. Yeah. I mean, it depends on your daily, weekly volumes, right? So
yeah, it's a rolling 4-week calculation. Yeah.
With the repurchase ongoing, obviously, I mean, I know you aren't going to comment on it specifically, but look, I mean, read the filing, do some investigation. You can see that Dorian's out there repurchasing shares. I don't know if they are today, but I could tell they were a few weeks ago. With that ongoing, Ted, you're going to run out of share authorization at some point. The sooner the better, because it means you're repurchasing more. When can you extend that thing up? I mean, can you get, because I know it's a 50 million.
I mean, there's really no time limit. It's just a matter of going to the board and getting authorization. And it's something that you'd be disappointed if we didn't talk about it every board meeting and in between. So it's a regular topic discussion. It's not very difficult for obviously. I mean, the board is supportive of it. That's why they authorized it. So it's not a particularly complicated discussion. And it's not a complicated process.
Certainly. When's the next board meeting?
No comment.
Okay, fair enough, Ted. Fair enough. We want more. I think re-upping that to 100 million program would be excellent. It's a good signal too, right? It shows that
Yeah,
you believe in
absolutely.
the market and
Absolutely. Yep.
believe in the company, and it's something really good to see. Look, Ted, we got to talk about it. We mentioned, we alluded to it earlier, but we got to talk about EEXI a little bit more and some of these environmental regulations. Look, you guys are kind of like, you have eco ships, they're very good tonnage, but is there any sort of risk or concern? I mean, I think there's some investors that might say these ships aren't good enough, right? I mean, what is there any sort of risk to that, and how are you addressing it?
I think the risk at this point is really, really modest. Again, the numbers aren't finalized. Look, there's no risk of obsolescence. These vessels are not going to all of a sudden, you're not going to wake up tomorrow night and find out that any class of vessel is all of a sudden now prohibited from trading. That's not the way the regs work, and that's not the case. If I had a 2000 built VLGC, would I be losing more sleep? Yeah, I would. There was an interesting piece that D&B did with KLP, the second largest Norwegian pension fund, and the shipping guy there, Simon Johansson's a pretty smart guy, and they basically came up with an analysis that showed that a lot of this panic has led, a lot of this, I won't say panic, a lot of this concern has led to, in their views, they see opportunity more in older tonnage than in younger tonnage, which is sort of interesting. And they've only done it for VLCCs and Capes, so I can't say how much it applies to our world. But the thesis was kind of interesting that we often see things get oversold when there are these trends. I think specifically with regard to our eco ships, or 2014 and on, I don't think we expect to lose too much in the way of speed. I don't even know that we'd lose a full knot. I don't know that we'd even lose half a knot in what we have to do. And what we'd have to do in terms of energy power limitation to engine power limitation to comply. That's the nearest thing on the horizon. I can't look so far down, because otherwise, if we really, truly believe that this carbon-free future is right around the corner, well, we probably got a problem. I just look, the technology and the economics and everything else. Again, the one thing that gives me a lot of pause for thought with this entire transition is, you know, carbon reduction is important. There's no question about it. But any sort of carbon reduction is an incredibly regressive tax. And if you look at, as I said at the outset, Jay, that 55% of the product is used in heating and cooking, and the vast majority of that is in the emerging markets. It would be hugely regressive to penalize LPG, which is a bridge fuel, much better than the alternatives. So yeah, we'll get there over time, but I don't see LPG, being an immediate victim of the shift to green. And there's no other way to ship the product than on our ships. So our kind of ships. And what does that mean? Well, it means that we should be around for a long time. Yes, we'll continue to comply. Yes, the industry's older ships, like every other sectors, will become increasingly disadvantaged. But I do feel like as a sector, VLGC has some more secular and environmental supports than somebody who's transporting something that's particularly dirty.
Well, certainly, and if you speak to any development economist or someone who has studied anything about like Indian markets and cooking markets, heating markets, and that sort of thing, just the environmental improvement from shifting into LPG is dramatic, right? We're putting away coal, peat moss, wood, animal dung in some cases. I mean, there's some really improvements to quality of life, and hopefully that trajectory continues.
Yep, absolutely. The UN's been big on that. They have Cooking for Life. The World LPG Association's turned out to be a very effective organization in communicating the benefits of LPG. So all those things. Yeah, I mean, again, it's not to dismiss the technological changes on the horizon, but I think they're probably a little further out than some would care to admit. And I do think that our particular asset class probably has some other built-in advantages compared to others.
Yeah, well, what's important is that you're keeping both eyes open and you're paying attention to the regulations, and you're gonna, adjust to whatever comes across the horizon. Let's ask a little bit, because it's a big news item, and it was kind of funny with the oil markets yesterday. But what's your viewpoint on the removal, or potential, I should say, potential removal? I think everyone knows it's going to happen, but removal of Iran sanctions. What's that going to mean for VLGC markets? Is there any sort of impact?
Modest. Their infrastructure is pretty beat up. There's also, there's so many layers of sanctions, right? So, first of all, Iran's maybe good for 3 million metric tons a year of exports. That's not such a big chunk. Some of that may go overland to Afghanistan, or other places into the former Soviet Union. The other thing is, their port infrastructure is a little bit weak, and even though sanctions will probably get lifted, as you said, there's so many layers of sanctions, and one of the biggest issues has been, and it's not clear to me because I haven't seen all the details and haven't gotten the usual missives from the helpful lawyers and others, but the historical issue was P&I, which is really important insurance, production indemnity insurance, wouldn't cover you in Iran because of sanctions. Even though the EU didn't have it, America did. It really is going to depend on the extent to which these sanctions are rolled back. If all they do is take certain people and certain industries off the blacklist and sort of allow Iran back into the global financial community, again, the worst case scenario is probably 3 million metric tons of additional export volume. Historically, we haven't seen much, but China takes all of it because they're the only ones that could take it. They've historically had to sell at a significant discount to world market prices. If they're back in the field, back on the playing field, then they should be able to sell at market prices. So I think it's probably net neutral. It's just not a big enough. They're just not a big enough player in the sector, one way or the other.
It seems like there'd be more of an impact to the actual world oil markets, if anything, as opposed to NGLs.
Yes.
But speaking of impacts, OPEC obviously is going to start exporting a little bit more oil here in the coming months, and especially into next year. And part of that is going to be NGLs, and OPEC as a whole is a lot bigger, right, than just Iran. So what sort of impact is that going to have on your market?
The OPEC plus, increases. Look, it's going to create more volumes, and it's sort of classic, Jay. I mean, it's hard to say, right? Because if we're in the midst of a global economic rebound, and we're seeing continued firm commodity prices, it's going to depend on what the ARB does, because Saudi's still the biggest. Well, they've come off. Qatar's now the biggest exporter out of the Gulf. But they can, Saudi can add more, they can subtract more. There are a lot of levers that can be pulled, but overall, we tend to take the view that more volume is generally good for a shipping company, as long as it doesn't destroy the ARB, because there's no profits. But again, I sound like a broken record, but we've also got all the benefits of the secular growth that we've talked about, with LPG taking fuel market share from other sources on the domestic front. So. I think it's going to depend on the magnitude. It's going to depend on what impact, if any, it has on the ARB. But I'd like to think it's going to be a modest positive to the market in a worst case scenario, and maybe even quite good in a better or best case scenario.
We'll have to keep watching it, right? And I imagine part of that dynamic is going to be how competitive can U.S. exports be. And right now, U.S. exports, it's difficult for them to be competitive because the inventories are lower. But if U.S. inventories bump up and oil keeps rising, then we'll keep our fingers crossed, because that'd be like the best case scenario, is that oil improves a little bit further, and then U.S. inventories improve, and then suddenly we could even be back to 2019 levels there.
Yeah, it's not impossible, but as you point out, a lot of variables at play.
Certainly, and of course, those variables could also worsen it. Shipping is a volatile business, which is why it's good to keep that balance sheet leverage down. I'd be remiss, I should have brought it up earlier, but I'd be remiss if I didn't circle back now. There's a lot of folks who were very happy with how Dorian is managed and the balance sheet and all that, but they like dividends. Repurchases are great and all, but what they really want is a dividend. Is there any thought to that, or perhaps a special dividend, or even a regular sort of dividend? Has there been any discussion on that?
Yeah, that's a great question that I thought you were going to let me off the hook on, but no such luck. No, look, I think look, I'm a shareholder. I sell shares when I have to personally. A dividend would be great. I'd love it. I think it's something that always gets discussed, and it's sort of that classic corporate finance discussion. It's economically the same. We all know that there are impacts to trading volumes. There's the argument that you're rewarding exiting shareholders, not committed shareholders. So there's a lot of discussion that goes around. And I still think that from our corporate perspective, when you see such huge intrinsic discounts to NAV, it's hard to turn down the opportunity to repurchase stock. But on the other hand, there probably needs to be some macro catalysts to help narrow that gap. Not just rates. I think there have been no transactions of modern tonnage. So brokers say that a modern built ship is worth X. Investors go, I don't know, show me. So that also militates, frankly, in favor of a dividend to sort of help give people more visibility into earnings and more immediate payback on their investment. Look, our two peers both are dividend payers. So that's a very long-winded way of saying it is something that is always discussed and it remains under very close observation. There's no question that folks want it, especially folks who are like, no, I'm not interested in selling. And so it's a regular topic of discussion amongst management and the board.
Certainly makes sense, Ted. I know we've had big picture debates in the past. I think we've sort of agreed on principle that a fixed dividend, or at least a strong high fixed dividend, is not quite the approach for shipping. It's misleading, right?
Yes.
And it's and then you have to sometimes reduce it, and the market's low, and then you get all these bogus headlines about dividend cuts, and so it's risky. But a variable dividend, I think.
Variable, no, I think it's fair to say that I'll speak for myself only. I think a variable dividend makes sense. That's what our peers do. They target a percentage of net income, which is a bit goofy because net income and doesn't capture all the future capex and everything else. But of course you can back solve to make it work. But our two peers, BW and Avance, both pay dividends based on a percentage of net income, and that would seem to make a lot of sense for us as well, being operating in the same sector.
Certainly makes sense, Ted. And then of course there's kind of two models out there. There's I guess the sort of like DHT and Euronav model, which is 50% and 80% respectively. And
Yep.
And that's really easy to understand. It's clear. And I think Euronav also has, they have a minimum dividend of like 3 cents. Right.
Yep.
So there's a way to put in a fixed variable, or a fixed and variable where
floor plus an upside. Yep.
Exactly. And then people don't say, well, the quarter's rough, but at least I got a nickel,
Right.
So that would be, if I have a chance to advocate, I would advocate for something like a nickel or a dime, plus 50% earnings per share or something. It's easy to understand. It's nice and stable. And look, when the market's good, you reward everybody, including yourself, right, as a shareholder.
Absolutely.
So that's my advocacy piece there, Ted. I always get on the
announcement from J Mintzmyer. Noted.
That's right. A dime plus 50% EPS. That's what I want to see. All right, Ted. I appreciate you. Let's close out with your sales pitch. So what makes Dorian? There's 3 peers, right? There's only one U.S. listed, so I already gave you
you give me that one. I took one away from me.
Yeah, I'll give you one there. So it took one away. So you better, hopefully you brought more than that. You got 2 more peers on the Oslo market. You got Avance and BW LPG.
Yep.
There's 3 companies investors can pick from, similar-ish valuations, similar, right? Why pick Dorian? Why go in with you guys? What makes you better?
Look, I'd say first of all, we are, let's see here. I mean, obviously, look, U.S. listing is a big deal. You kind of took that one away from me, but that's a big deal. We share very few investors with BW and Avance. I think secondly, we've got we're truly got an independent board. both of those guys have large shareholders whose interests may or may not be aligned with the rest of the public. And I'm not saying they aren't, but I'm just saying, for what U.S. investors are used to, we look a lot more like a typical U.S. investable asset than, say, some others. I think we've been absolutely at the forefront of technological investment and awareness of regulatory changes and being nimble. I think we have been responsible and disciplined about capital allocation. And again, I'm not throwing stones at the other guys, but we didn't get out over our skis at the bottom of the cycle and have to go out and ask for money, as one of our peers did. I think being in the U.S. does offer some strategic benefit commercially. We're closer to the most important export market in the world. Can I quantify it? No, but can I tell you it's probably better to be sitting in Connecticut and talking to all the players on a regular basis in the same time zone roughly, and than it is sitting abroad and doing the same thing. Yeah, I think there is a benefit to that. And I think our capital, again, I'm not going to throw stones at the other guy's capital allocation, but I think ours is transparent. It's obvious what we're doing, and hopefully it's attractive. And I also think we're not so dogmatically wed to one approach or the other. So as you've rightly pointed out, buybacks are great. What do you guys think about a dividend? We're not going to say we'll never say never to a dividend. Our peers don't really do buybacks. So if you like that, that's not an option for you. So I guess it's a combination of technological prowess, geography, both from a capital markets and a commercial perspective, and I think a clear and transparent capital allocation policy.
Thanks again for joining us, Ted. I think you shared some good insights on the overall LPG markets and then, of course, on your firm as well.
Thanks a lot, Jay. Really appreciate the time, and thanks to all the investors who took the time to participate as well.
This includes another iteration of Value Investors Edge Live, recording on June 11th, 2021, about 10 o'clock Eastern Time. As I mentioned throughout the call, I do have a long position in Dorian LPG. I also have a long position in Pure BW LPG, which is traded on the Oslo Exchange. Stock symbol, easy enough, BW LPG. This is a recording. If you're listening to it at a later date, please look for the latest updated disclosures.